All right. Good evening, everybody. Thanks for coming. Confirmed attending remotely, Councillor Ayos, and Councillor Adebayo, and Eri and Jonathan, and Georgia Lazari, legal advisor. So a warm welcome to you all. Apologies for absence. Apology for absence have been received from Councillor Walker, Gordon, and Radbourne, and Councillor Chapman. Apologies for lateness, none. Agenda item 1, the declarations of interest. Use my glasses. Yeah. Members may declare any disclosable pecuniary or non-pecuniary interest in any item coming before the Pensions Committee. They must state the item for which they are declaring an interest and what the interest is at this must be properly minuted. Where this declaration is for a disclosable pecuniary interest, the member must leave the room when the item which the members has an interest is being discussed, unless the members has obtained dispensation from the monitoring officer or standard committee to remain in the room and participate in the meeting. Where a member has a non-pecuniary interest, he or she must declare the existence and nature of the interest in relation to the relevant agenda item as soon as it becomes apparent to him or her. He or she may remain in the room, participate in the discussion or vote provided that contractual, financial, consent, permission, or license matters are not under consideration relating to the item in which the member has an interest. If this is so, the member must leave the room unless the member has obtained a dispensation from the monitoring officer or standard committee. So any declaration of interest? None? Yeah? Okay. My wife's a member of a local government pension. I don't know if that's relevant, but I'm not, but my wife is. Agenda item 3, consideration of the minutes of the previous meeting. Are there any matter arising from the minutes? Members? Any matter arising from the last meeting minutes? John? Lynn? Any matter arising? No? All right. Can we agree the minutes of the meeting held on 29 September 2022 as contained in the agenda pack?
Agreed.
Great, thank you. Right. Is Councillor Bini Lobak on the line? Yes. So he's got some questions. I'm thinking like maybe we can deal with that first before we go into the training. Councillor.
Yeah, let me just bring them up here.
Yes, can you ask your question? So
yeah,
that we can take...
I had 5 questions. Hopefully that's not too much. I can rattle through them quickly. I did send them in advance so that they could be considered. Let me just grab them here. Sorry, one moment. Okay, so my first question was, what proportion of investments, including the pooled arrangements, are currently in renewable infrastructure, and what proportion are in companies that primarily extract and trade in fossil fuels? And I assume this is a different figure to what's counted as exposure to carbon risk. My second question is, in the Pensions Committee report, why are some committee members listed as non-applicable in the attendance list? In the annual report, it also says that the target of being net zero is by 2040. And so I just wanted to check how this aligns with the Council's new stated aim of being net zero by 2030. And I just want to make sure that that doesn't mean that there'll be lots of debunked carbon offsetting. And then my fourth question was, what does the council's stronger engagement approach look like in practice? I assume this means engagement with pension holders, but that wasn't very clear from my reading of it. And the final question was on page, on point 3.5.9, it refers to Councillor Chapman as the chair of the Pensions Committee. So I just wondered if that needed correcting in the paper. Those were my questions.
All right, thank you. I believe that Councillor Gabbard, she's got questions as well. If you can get that one as well through to us, that'd be very useful. So I think Rachel will try and provide some answers to the questions. So Rachel.
Thank you. Yep, I'm happy to respond. So in terms of your first question, at the moment, around 1.3% of the fund's investments are held in renewable infrastructure. The total allocation that we'll build up to over the next couple of years is 5%. The investment takes a little bit of time to fully fund, and it's drawn down over a period of a couple of years. And the manager for that investment is the London CIV. In terms of the proportion invested in companies extracting and traded in fossil fuels, we are not able to provide an answer for you today, but we will take that away and we'll provide you an answer as soon as possible within the next couple of weeks, and hopefully that's okay. As you say, that is a different figure to the decarbonisation figure given. And we should be able to give you an update within a couple of weeks. In terms of question 2, committee members listed as NA in the attendance list. That's simply as the membership of the committee changed during 21-22. So where a member's attendance is marked as not applicable, they weren't a committee member at the time of the meeting, so we wouldn't have expected them to attend. So committee membership at the moment is 9, but you'll see more than 9 listed in the table, as there were a couple of changes during the year. In terms of the alignment with the council's aim to be net zero by 2030, essentially the journey to net zero for pension funds looks very, very different to that of local authorities, and it needs to be approached quite differently. So it is quite common for LGPS funds to set ambitions and targets that do differ from the host authority. I'll ask Anastasia, our consultant from our investment consultant Reddington, to go into a little bit more detail in a minute. But essentially, net zero for a pension fund requires alignment of the investment strategy, with net zero, which essentially you're looking at having the underlying investee companies align with a particular net zero pathway, and requiring all of the companies that we invest in to align to a 2030 target would very significantly limit our investment universe. And essentially that runs counter to the primary fiduciary duties of this committee. What I would say is our ambition of net zero by 2040 that is an ambitious target for pension funds, and it can be considered to be broadly aligned to a 1.5 degree warming strategy, which would require net zero by around 2045 to 2055. Anastasia will be able to give a little bit more detail around some of the challenges of a 2030 strategy.
Thanks, Rachel. So, going to what Rachel was saying, there are two inherently different problems. With your funds as a pension, you're trying to decarbonize the global economy because you invest in the global economy. But with your council, you are trying to decarbonize the infrastructure and the operations of the quite small, in comparison to the global economy, council work that you do. And so inherently what you can do in 2030 is going to be very, very different. One, because it's just a very small sliver of the economy that your fund looks at and invests in and has to realize returns. And two, because you're in full control of it. You run your buildings, you run your people, you do everything directly. With your pool of capital, if you're trying to decarbonize the pool of capital, you could do it tomorrow. It's really, really easy. But all you're doing is changing and divesting out of things that are dirty into things that are clean now. You're not helping the transition, you're not helping the real world decarbonization, you're not even getting involved with that. So in many ways, there are two completely different problems. And as you can see, when you're trying to decarbonize the global economy, because you're invested in the global economy, it's a much harder task. And actually, the level of ambition that the council has, I do this for other clients, and I say, these 2030 targets, we have to see it as declaring climate emergency, see it as the employer telling us that they are very, very ambitious and very serious. And you see that as a statement of intent. And we take that very seriously and try to provide strategies and implementation to match that statement of intent. I mean, frankly, 2050 is a typical target for 1.5 degrees, let alone 2040. So two very different problems with two different solutions.
Hey, thank you. Coming back to your fourth question, which is around the council's engagement approach. So rather than engagement with pension holders, the approach refers to engagement with the fund's investment managers and investee companies, which is essentially our primary route of influence. If we are looking, as Anastasia's mentioned, if we're looking to change real world behaviour. So in practice, strengthening our engagement approach, it means requiring greater oversight by our managers of the environmental, social and governance risks within the portfolio. It means increased engagement on what they're doing to address those risks, and then further follow-up work on outcomes. So we are, we have to acknowledge we are a relatively small investor, and we have relatively little impact alone. So one of the things we also want to look at is greater collaborative working. So working both with our investment managers and with other funds, say through the local authority pension fund forum, and with our asset pool, the London CIV, and look at a sort of collective ambition to drive improvements amongst investee companies. It's also our intention to improve our governance in this area. So we're setting up a dedicated subcommittee within a working group within the committee to focus specifically on ESG issues and responsible investment more generally within the fund. So hopefully that answers your question around engagement. And the final fifth question, apologies, that ought to refer to Councillor Chapman as the vice chair of this committee. So my apologies on that one.
Jonathan. I think you're on mute. Jonathan, you're on mute. All right, we'll come back to you. Councillor Benilobok, do you have any more questions or any comment?
I just want to thanks for those really good answers, and I look forward to finding out how much you're invested in fossil fuels as well. I was just going to say, if you do have time for a further question from Councillor Garbett, I have got that now, which was just around has the Pensions Committee considered using investment to buy social housing? Is that something that the pension fund could do and look at that as an investment worth investing in?
It's certainly something that we would be happy to consider at our next strategy review. Obviously, decision making around investment. It is still subject to the council's primary fiduciary duties. But obviously, it is something we would be happy to consider at our next review.
Thank you. Jonathan?
Good evening. Thank you very much, Chair. Can you hear me?
Yeah, we can hear you.
Hooray. Alistair, welcome to the Pensions Committee. It's Jonathan Malin-Smith talking. Yes, you can see me here. I'm glad to see you now as a councillor. Well done. Do I see Jill Davis in the audience as well? Is she there? Maybe not. My point is, this is the Pensions Committee. We are here as quasi-trustees. We have to be very careful of bringing in political ideologies that may well affect the investment assets that we've all got a responsibility for. Thank goodness the pension fund is now in surplus. It's taken a long time to get to this position, and the last thing that we want to do is to narrow down the available investment universe, because we, after all, have got to look after the interests of our beneficiaries. Thank you.
Thank you, Jonathan. Alistair?
Just quickly to come back to that point, thank you very much, Jonathan. Yeah, I really appreciate the environment, and I look forward to seeing the work that the Pension Committee is doing. That was kind of part of my question around the engagement of the pension fund members, because I think that could be potentially a mistrick in that, rather than it being political, one of the things that the council could do is engage with members around what kind of things they would like to see, as been said earlier, about how we want to change the economy and the world that we live in through the investments that we hold. Thank you.
Thank you, Councillor Bini-Lebok. Do you, apart from that, do you have any other comment or something?
No, that's everything. Thank you very much.
Okay, I'll try and see if Rachel can send you a written response to that, so you can have that. Maybe not tomorrow, but at some point, maybe you get a written reply back to everything, right? Okay. Jonathan, please, you have your comment?
Chair, thank you very much. Alistair, I would remind you that we've got responsibility for a defined benefit pension scheme. The majority of assets are in a defined benefit scheme. Members do have some DC direct contribution exposure, but it's de minimis. And because it's defined benefit, it's subject to a formula. So actually members' views are relevant, but not major. And this is the thing, this is the dilemma that we as quasi-trustees have got to manage. Over to you.
Thank you. Rachel, do you have any comment? Any more comment?
No, only to thank both for their comments, and to note that we will put out a written response to those questions within the next few days. Obviously pending that analysis of investments in fossil fuel extraction.
Thank you. If there's no further questions, then we can move on to the next agenda item, or trading TCFD from Renington, right? So Councillor Lebok, you can log off now. So thank you very much. Thank you. Training, thank you. Rachel, you can introduce yourself. Sorry.
Perfect. Yeah, no, that's all right. No, so essentially, I'm very happy to introduce Reddington, who are our new investment consultants, following their successful bid for the contract this autumn. So welcome to Jill and to Anastasia. I don't know if you'd like to give a short introduction, and then we can look to move into the training.
Good evening, everybody. I'm Jill Davis. I'm head of LGPS at Reddington. We're absolutely delighted to be working with Hackney. I'm really looking forward to supporting you as you go through the strategic asset allocation review, but also perhaps equally importantly, help you on your climate journey. And we've certainly been working with a large number of funds to do that. Over to you, Anastasia.
Thanks, Jill. Hello, everyone. Nice to see you again. I am Anastasia Guha. I'm the Global Head of Sustainable Investment at Reddington. And like Jill said, really happy to work with you because we think this is a real opportunity to lead from the front when it comes to setting sensible net zero strategies and achieving them. Okay, so towards that end, we'll start today with a training on the Task Force for Climate-Related Financial Disclosures, which may be coming your way in December of 2024, which is when your regulator is going to ask all schemes to do this, and also on net zero. And a few things I want to do. I want to take you through a sort of state of the nation. Where are we as a planet on net zero and as an economy on net zero globally? So it kind of gives us some context in which we're operating, because we definitely need to think of context all the time. We'll talk about TCFD in a little bit of detail in a sort of high level, simple way to say what is TCFD, what does it do, and how could it work for you? We'll talk about some ways that other investors and other pools of capital are thinking about net zero strategy setting, so that it just softens the ground for some ideas for what this scheme could also be doing. And finally, we'll talk a little bit about next steps around targets and setting targets for the scheme that are interim targets. Of course, you have your 2040 net zero target, but we need an interim target for climate risk frameworks, including TCFD. So that's what we'll do in the training. And please do feel free to ask questions throughout so that it's not a one-way discussion. So if you go to page 2 on your deck, we'll talk about looking at financial risk and understanding how climate change is a financial risk in your portfolios. And what TCFD does, and I want to say this to start with, because I've worked with a lot of private sector schemes who've had to do this on a statutory basis. And I want to make sure that we've learned from our mistakes with them, because we were doing it for the first time when we were doing it there, is what is it that we get lost with TCFD? Well, it is a framework and there are some complications and it can get technical, but what it really is at the heart is a way to think about climate risk, to govern it, to look at the risks of it, to look at the strategy on it, to set targets on it, and do it on a regular basis. And what we want to do with you, given we've got about an 18-month runway to actually produce this, is to use it to think about our strategy and our process or an implementation, so that TCFD is the end disclosure of a set of actions rather than the start. And so what are the two things we'd be looking at? We'd be looking at transition risks. So this is risks related to increased regulation. So what happens if in 3 years' time, we see more regulations like the one we already have in this country, like all internal combustion engines, also known as ICE, regular cars essentially, that use petrol and diesel, will be phased out in 2035. That's in 12 years. They'll be phased out. What impact is that going to have on the portfolio? All of the companies that actually deal with autos directly, but also those who supply to them. Stranded asset risk. Again, we know that there are assets that you own and everyone else in the global economy owns today that it is impossible to burn or use if you want to keep the planet to 1.5 degrees of warming. At the moment, and I'll give you a real world example of this, we went into years ago when I was at the UN Principles, we went into a conversation with Exxon, and we said, but you've got a lot of stranded asset risks. And they said, well, that's if you believe that the world will actually try to stop decarbonization. So they thought that the way they were modeling their business strategy was based on a 4 or 5 degree world, where all of their current exploration would come to pumps and you would be buying them. So we think there might be policy interventions, and that's a transition risk to stop stranded assets. And suddenly, one day, you can't sell them anymore. It's like Russia. Can't sell it anymore. It goes to zero. It doesn't just reduce in price. So that's a stranded asset risk. Technology risk, of course, everyone talks about the Kodak moment. What if that happens across a range of industries that just don't operate anymore because they didn't update, and you're holding a lot of that in your portfolio? And then, of course, market volatility. Now, what that means is a lot of the forecasting of financial markets and specific companies that are done by your fund managers are based on preferences, consumer demand shifts, whether their products are keeping pace with the market. In this market, for instance, supermarkets have to think more of vegan food and vegetarian food and so on and so forth. Now, what happens if those shifts happen faster than expected? Because everything in global climate risk is happening faster than expected. So what happens if you hold all of that? Now, all of those things are transition risks. What you're looking at is, will the portfolio be able to withstand all of these changes? So that's one. The second one is physical risk, which is the assets that you hold, and this is particularly true of non-listed assets, so not publicly traded companies or debt, but private assets, where you actually hold the asset, whether it's a real estate or other types of assets. Will they be actually impacted by climate change on a physical basis? So again, asset damage is really important. I'll give you an example. In Florida, there was one of the worst hurricanes in the last 6 weeks that have ever happened. And a lot of commercial real estate in Miami has, as a result, become uninsurable. So if you were invested in a fund that was invested in those assets, that's a pretty bad bet to be on the other side of. Market volatility, of course, because when things go very wrong, then you see a lot of volatility take place. Resource depletion and trade supply chain disruptions is essentially all hinting at chaos in the global markets. If physical risks of climate change started to manifest in any significant way, even in economies which seem underweight in the portfolio, they could lead to chain reactions. And so you start to see both transition risk and physical risks playing out. Just again, so you're aware, just globally and in the way that the climate finance world works, transition risks are well understood, they're well quantified, physical risks less so. So you'll see the data for transition risks being pretty good, the data for physical risks being a little bit poorer. So how are pools of capital and capital allocators like yourself thinking about the challenge? Now, you start to see, if you think of your own profile, the profile fits into broadly 3 buckets. You get the measure and manage bucket, those who believe that these are financially material risks and that you need to monitor them and deal with the risk that you are facing from the world. So what impact is the world having on the portfolio, and to try and mitigate those risks. So you have the measure and manage crowd, you have the seek opportunities crowd. So you know that climate transition would lead to winners, and you want to make sure that you're on the side of those winners and you have an upside. This is particularly true for funds like yours that are open DB schemes. You have to keep looking at growth assets and thinking about where future returns will come from. And then finally you have and both of these, by the way, are regulatory requirements now within TCFD. You have to manage and measure, and you also have to at least tell us, the regulator, how you're thinking about opportunities. You might not be doing much, but you have to have the thinking in place. And finally is the external impact. Now, this is the impact the portfolio is having on the world. And this is a very interesting concept, and one that, again, let's talk about Hackney specifically. The conversation that we were having with the councillor just now was exactly that. If you're trying to have an impact on the world, decarbonizing your portfolio by financial engineering is not going to change anything. So that external impact, if that's what you're looking for, leads to a different set of strategy decisions and a different set of implementation. And so the thing that you would do, in your case, measure and manage and seek opportunities, you have to do that. You would decide whether you're doing external impact, and I would go so far as to say you've already decided that because of who you are, because of your 2040 net zero target. So really, it's just about how can you do that well. Now let's look at the TCFD framework and how this applies to LGPS. Now I'll go slowly. I know a lot of this team is away today because of illness, but this is what you'll be looking at for the next 2 years. So it's really important to start bedding it in. So there are 4 things that you need to look at. How do you think about this space? Yes. Yeah, administering authority. Apologies. I know. We'll try. You keep asking us questions. We'll try and make it simpler. So, what is this about? It's about what should you be doing to think about this in a systematic way. So, what are you doing on the governance side of things? And here, what they really mean is who's looking at it, how often do they look at it, how often do they discuss it, what do they discuss, what do the meetings look like? That's the governance bit. You then have the strategy bit, which is, have you identified the risks and the opportunities on an ongoing basis? And importantly, and we'll talk about this in the next page, is have you done scenario analysis? And what that is if things were to go really wrong in the climate space, if you would start to see the impacts of strong physical risks and strong transition risks, how would the portfolio react on a downside scenario? Now, you do this on financial analysis all the time. It's part of the way you think about funding and valuation models. It's doing the same thing, but from a climate perspective. So that's strategy, and that's going to help you to decide where your key risks lie and what you want to do about them. Then you've got the risk management, which is actually putting this on the risk register along with your other risks and deciding how you think about this in different timeframes. How do you think about the short-term risk versus the medium-term risk versus the long-term risk? And finally, it asks you to, once you've done all the thinking, the strategy and the risk management, it asks you to get the data. So what is your carbon footprint? And a few other points we'll just discuss in a second, and then set a target against one of those. So the governance, strategy, and risk are there to be able to do the job of meeting the goal that you're going to set a target on. So if we go to page 6, if there are no questions, going back to the scenario analysis. Scenario analysis is we found doing this for the private sector, that scenario analysis is perhaps one of the trickier bits, not just to actually conduct, but also to understand and sort of base decisions on. We have made a response to the DULUC off the back of our experience, but what currently is in the regulation, or what the draft regulation, is that you do the scenario analysis, that at least 2 scenarios are looked at, one of which is 2 degrees and below, and the other one is left up to your choice. And then the second thing, and lastly, that you do the best possible job that you can, and you commit to improving that over time. You'll hear much more about this as we go through next year, but yeah.
Sorry, yeah, I've got a question. I'm just curious about the scenario. Is there 2 scenarios? So the second one, what is the purpose of the second one?
So for instance, the first one is a 2 degree and below scenario. And the second one typically is a if the world didn't transition scenario. So it's typically between a 3 and 4 degree scenario. So to give you a sense of what that means, in the 2 degree scenario, 2 degrees or below scenario, you see a lot of transition risk because everyone has to move pretty quickly as a global economy. And in the 3+ degrees, 3 or 4 degree scenario, you see a lot of physical risk. Essentially, we've not done anything about it, and the world is just starting to come apart from a climate perspective. So those are the 2 different things or risk that you will associate with the 2 scenarios. Now, you could even do 3. We typically do 3 for our clients, which means a fast transition to net zero, a slower transition to net zero, and then finally a no transition. And that helps to understand again where the risks lie. Now, what are the metrics and targets that have to be set? Now, this is, again, we'll do more training on this later, but essentially the first one is absolute emissions. Literally, that means how much CO2 does, or CO2 equivalent, does the pension scheme put out through its investments. And whilst this is not a very popular measure in the climate finance space, it's actually in the global economy, it's the most important measure, because essentially what we're trying to do is get that to net zero, as close to zero as possible. So that's the absolute emissions. The second one is emissions intensity, which is, okay, well, you're holding assets that are producing this amount, but what is the carbon footprint? So what is per £1,000,000 invested by Hackney? What is your carbon footprint? And what that helps you do is show you which bits of the portfolio are the dirtiest. So within your portfolio, which, given your achievement of your of some of your decarbonization goals, you will have a fairly clean portfolio in relation to the rest of the world anyway. But within your portfolio, which bits are the dirtiest? Which bits have the most amount of pollution in them? Then the third is data quality. Now, data is really problematic, and for avoidance of doubt, and I'm sure you hear about this a lot, companies are not expected to report their carbon emissions outside of the OECD developed world. Think about your portfolio. The vast amount of companies that you hold only say scope 1 and scope 2 emissions, which is what does it, how much do they pollute when they actually produce their product, and how much they pollute through their offices, essentially through water and electricity. And even that is unaudited and unverified, let alone scope 3, which is how much does use of the product actually cause emissions. And so this is a really, really problematic thing. Your regulator is saying data quality needs to be a metric, which means all the data that you're talking about in terms of your emissions and emissions intensity, they want to know whether it's verified, i.e. audited, whether it's reported by the primary source, which is the company, whether it's estimated by your fund managers or by your data providers or consultants, and whether there are other parts of it that are just unavailable. And if you're holding some private assets, there will be parts that you just don't have any data for. So that's an important metric. It seems simple, but it has an outsized impact. You can really have an impact by expecting more from your agents and your data providers and managers. And finally, and we think this is particularly key, perhaps the most key metric, which is the portfolio alignment metric. Remember what that is, and if you we can look at this in a second. But what that is what is your portfolio aligned to, i.e., what degree temperature rise would your portfolio have today? And it's a really useful way to look at the future, because everything that you're doing on emissions intensity, and data quality is looking at the past. What happened last year, the year before, and all the years before that. Whereas alignment is what's going to happen in the future. So has the company actually aligned to the future? That's what you want to manage to, because your 1.5 degrees by 2040 target is an alignment target, because the world is heading for 2.6 degrees. You've said you want it to be 1.5 degrees. You want the fund to be at 1.5 degrees at 2040. So you can see that this is the target you've set. You haven't realized it potentially, but you have set an alignment target. And we strongly encourage you to actually manage to that target, because a lot of discussions with fund managers and how you hold them to account become much clearer when you look at that target. So we've talked about TCFD. That's TCFD. It can be actually quite a straightforward thing when you break it up into chunks. But how do you get it right? We think you allocate the time and you allocate the governance to do it. And when we were talking to the officers, we were saying that what we suggest you do is think of it as the end of a process, with setting up your climate goals, strategies, targets, and training as the start of the process. So that when you come to write the report, it will really not be that, because you would have gone through everything in it. And it's just a writing exercise or a compiling exercise. So that's what we think we should do. You should allocate the time and get your governance in order first. Understand the levers that you can use so that we can you have a particularly active stakeholder base, being who you are, and it's if all of this group can understand the things that you're doing, the context that you're doing them in, then you're in a good position to actually kind of go back to councillors and others to say, we're actually leading with intent here. So understanding the levers you can use, whether it's investing differently, engaging differently, or even thinking about managed phase out or exclusions.
Question, Jonathan.
Thank you, Chair. Hello, Anastasia. My name's Jonathan. I'm the scheme member representative. I've already mentioned that we are concerned with a DB scheme. A little bit is DC, but the majority is DB. That is formulaic. I hope you would agree. Also, I would challenge you about this statement that you are talking to an active stakeholder base. As the scheme member representative, I've only had one expression of interest in our investments from an underlying member, a beneficiary. And I would like Rachel, and if Michael's there, I'd like him to confirm that there's minimal engagement from our membership base. Thank you.
I mean, in response to your comment, Jonathan, I mean, I think it is reasonably true to say we have received more than one query from scheme members, but I would acknowledge that our membership totals nearly 26,000 members. I would acknowledge that given the size of our membership, the engagement by members in our investment policy is relatively low. We do have some members who are a little bit more engaged on the subject, and we do receive inquiries from them. What I'd probably add to that, though, is I can't speak for other defined benefit schemes, but I am minded to think that is partly a function of the membership's disconnection from the investment strategy. Member benefits are set out in law; they are not dependent on our investment performance, and to my mind, it does therefore stand to reason that there is less engagement from the membership on the subject. I do feel, however, that we have certainly in the past had some quite active engagement from local residents in Hackney, and also from within the council itself. So I think there are elements of the fund that are more engaged than others.
Richard, Jonathan.
Chair, thank you very much. Thank you, Rachel. It's interesting that you are confusing two communities. We have got responsibility to the scheme beneficiaries, not to residents of Hackney Borough. Councillors have a responsibility to residents of Hackney Borough because they are their electorate. We are not political, or we should not be political. When we come into pension committee meetings, we have to shed politicisation and ideological actions. Thank you.
Sorry, Jonathan, just to follow up on that. Certainly in terms of the engagement on certain topics, I certainly would draw a distinction between the two groups, and don't confuse the two populations. I think the inquiries that we tend to going by inquiries only, the inquiries we receive from our membership are quite different to those that we receive from local residents. But we do obviously, we appreciate that we are not necessarily here to serve local, as a pension fund, we are here to serve our membership, but we do, out of courtesy, reply to local residents, as it is their right to be kept informed.
Jonathan again.
Thank you,
Jonathan.
Chair. Thank you, Chair. Rachel, thank you very much. I think we need to be clear as to which community we have got responsibilities for. I am the scheme member representative. I have not been shown anything, zero, from the fund officers about these issues, about members' concerns. I look forward to seeing such. Thank you.
Jonathan, my apologies. I will happily pass them on to you when I receive them.
Henry, do you want to come in?
Yeah, no, just to slightly reinforce Jonathan's point. Obviously, I'm coming from the standpoint of an employer representative. I do think we've got to understand the fiduciary responsibilities on the pensions committee. All I can say, admittedly, as a representative of probably 1% of the scheme in terms of the non-council employers, we are clearly interested in how this investment strategy works with the climate change strategy approach. But it is incredibly important we do not lose sight of what we're trying to do, which is to pay these pensions. And as an employer representative, we are obviously very concerned about the amount paid by our own employees alongside the Hackney Council employees, and it's much more of a financial question. I'm totally on top of this climate stuff. I get it all over the place with other roles that I hold, and clearly we must play our part, which is why active engagement is so important in doing whatever we can to accelerate this move towards net zero as soon as possible. 2040 seems to be the only conceivable date for investments. Really, we might get there a couple of years early, but I do worry that we do run the risk of losing sight of our primary responsibilities, pension as pension fund committee, which is, as Jonathan says, quasi trustees for this scheme. We can do a whole lot of things that might be immensely popular, but if they don't pay the pensions, we're not doing our job properly. So I just want to make that point.
Thanks, Henry, and thanks, Jonathan. So at no point will the fiduciary responsibility of paying pensions ever be superseded. And that's just the case for every single client that we work with. You can never sort of say, and one of the reasons we're being very, very risk-oriented about all this, I've probably said the word risk 20 times so far, is because we are looking at how is the world changing and what should it be doing with your investments off the back of that. Almost none of this is to the, I can't stress enough how important the fiduciary responsibility is to all of our clients. And what we're trying to do is build a risk-adjusted return rather than a return. So what we're trying to do is, like I said, we're trying to look at the risks to the portfolio and make sure that when we're looking at the returns and the expected returns, it's risk adjusted. So totally agree with you, and you will find us flying the flag for fiduciary duty all the way, which is why when I was speaking to the previous question of 2030 versus 2040, this 2040 is a very, very difficult target, let alone 2030. By the way, 2050 is a very, very difficult target as well. So totally recognize that, and I see a thumbs up, so I'll carry on. So finally, the space is also ever evolving, and interestingly enough, the pensions, both the private and the public pensions in this country, have moved before a lot of the world has, and as a result, the conversations with your UK and European fund managers, including your pool, will be much more advanced than many of your peers are having globally. And so that's something to take into account, that you are in many ways the vanguard of how to do this in a risk-adjusted way and still make the change that you want to see, so that your beta risk, your market risk, is minimized. I won't go too much into.
Excuse me, I got a question. A question is that earlier on, you spoke about the quality of the data. So those people reporting at this time now, how good is the report if the quality of the data is not that great?
So there are pockets of truly bad data, and they usually sit in the private markets, and there are pockets of data that are quite reliable. But what we have to learn to do in this space is to deal with that uncertainty, because we will see that uncertainty over time. We will solve for what we know for now. There are some pretty good proxies for some of the private markets data, which Reddington's happy to provide and will provide for you, along with your provider Trucost. So the data isn't perfect. It is estimated, but let's also remember a lot of financial data is estimated unless it's audited. And we are looking at 5 or 6 years before these accounts will be audited, but at the moment, we're not there yet. So we should be okay though. I mean, you can take action based on what you see. And when you see the data, you'll realize a lot of it is intuitive in terms of where does the risk come from. I won't go into slide 9, it's just a sense of what some of your peers are doing on TCFD reporting on a non-statutory basis. Again, just looking at context for looking at those risk-adjusted returns that we've been discussing. Slide 10 really looks at, this is the International Energy Agency. It's one of the world's most, sorry, I can see that it's small print. I'll speak through it, so hopefully you'll be able to read. What it's saying really is what is expected in the global economy to 2050, what needs to change, what needs to happen to get to these numbers. And why it's a useful thing to look at, and I can go into detail, but I'll just pick up a few things, is that it gives you a sense again of risk-adjusted returns, economy changing, and investing into that changing economy. So here you can see the, for instance, in 2030, 60% of global car sales are electric. In 2035, no new ICE is the internal combustion engine car sales. That's quite dramatic if you think about the time frame we're talking about. 2030 phase out of unabated coal in advanced economies. Now, interestingly, this is the 2021 modeling report. We will update this for the 2022 modeling report before long, which will take into account, of course, the twinned crises of global inflation and the war in Europe. But what we know is that a lot of these policy drivers and these macroeconomic projections are probably going to be correct. Not all of them, but a lot of them. And you can see some really interesting things where you can see that in 2040, when you plan to go net zero, there will be net zero emissions in electricity globally for the first time. So investing in that sort of a world is going to look very different than investing in 2022. And through the scenario analysis, we will bring more of these to Europe.
Yeah, I think Jonathan has got a question. Jonathan.
Chair, thank you very much. Anastasia, thank you for that observations. Can I just challenge you about what it is that the Western world is doing with regard to the ICE area of motor manufacturing and the rest of the world? And also to go back to the most recent COP, I think it was 27 meeting in Sharm el-Sheikh. You and I both know that we're on pretty dodgy ground with regard to the 1.5 degree scenario remaining as a legitimate target. Lots and lots of emerging nations are saying, hey, hang on, unless we get billions from the developed world, we can't accept that. So can I have your answer to that particular point? Thanks.
Thanks, Jonathan. I agree with everything you said. Could you just tell me what the question is?
Anastasia, apologies. My question is, COP27 went on and on after it was meant to end. Can you hear me?
Yes?
Yep. Okay. There was incredible debate about the result of COP27 as opposed to COP26 in Glasgow. COP27 has raised all sorts of fundamental issues about the desire of the world, bearing in mind we've got this growing population, we've got all these people wanting to aspire to Western levels of consumption to be able to achieve it. So I suppose my question is, I think that focus on climate it's a major issue, but it's only one issue that we've got to contend with.
Yes. So again, agree with everything you say, including 1.5 being alive on a life support, perhaps. So I think perhaps the question there is, will this transition happen? And are we doing the right thing by concentrating on this climate transition? The first one is almost impossible to predict. But here's the thing. I went to my first COP in Rio in 2012. And in 2012, the world was headed to 5 degrees of warming. COPs are 200 nations doing an incredibly complicated political choreography of trying to deal with a global problem which nobody has ever dealt with before, certainly not on a multilateral basis. So whilst they're important discussions, let's look at the trajectory of the Rio COP in 2012 to the COP I attended in 2015, which was in Paris, which set the below 2 degree global target, which 198 countries signed up to COP26 in Glasgow, at which point, and actually COP27 in Sharm, which has brought global temperatures, predicted global temperatures down to below 3 degrees. So over the course of 10 years of COP meetings and everything else, including and vastly a large amount of private sector work and private sector investments and people thinking about risk-adjusted returns and investing differently, we have reduced the worst outcomes by half. So I do think that we need to look at the long view. These are not going to be linear. And actually, one of the things you will find, which we've already found with clients who've run the numbers a couple of years running, is that world events mean that you might find your emissions going up, even though you're doing everything in your strategy to bring it down. And it's because of unexpected black swan events, including wars in Europe, etc. So no one expects the trajectory of the emissions curve to be linear and going down X% year on year. But overall, we need to bend the curve as a global economy. And in Hackney, because of your 2040 target, you probably need to think about a similar trajectory yourself. I'm very conscious of time, so I'm going to skim through the rest a little bit of this. So on page 11, you will see when we finished with this process of working with you, training, explaining, and getting all the data for you, making decisions, you making decisions and us sort of assimilating those decisions, this is what you'll end up with. A one page that looks at your carbon budget, your footprint, which was total absolute emissions and emissions intensity, portfolio alignment, we've discussed, transition risk and physical risk, we've discussed, mobilizing transition finance, effective engagement and what that will look like. We've discussed this today a little bit in terms of what that might look like, but also the questions from the committee and data quality. That is what it would look like. You can see some sort of objectives we could set. The top one is, of course, your stated objective, but the rest are all placeholders. And then targets off the back of those objectives. And I hope that it will give lots of comfort that this is very much a risk framework, looking at risk-adjusted returns. Now, we were told to think a little bit about setting interim targets, and Rachel and the chair, you could tell me how much detail you want to go into this, but the way that the IPCC has which is the Interplanetary Council for Climate Change, about all 200 nations signed up to COP, provide scientists who by consensus produce a document. You can imagine what that looks like, as bad as COP. But what they have said is that we have to reduce our emissions as a global economy by 45 to 50% by 2030. And so when you look at the private sector, and you look at all those in the private sector who've set 2030 targets, many of them DB schemes, heavily risk focused, heavily thinking about fiduciary duty first, paying pensions and other liabilities like insurance. Many of them have set a 50% by 2030 target as their interim target, just because it's the norm, not because it's achievable, not because they've done lots of analysis to show that's the right target. So that's just something to consider, that a lot of the data work that goes into this can sometimes be spurious, and people just stick with the norms and try to do their best to get there. And there's a sort of fatalism in the market around, if we fail, we'll fail together, around that. So that's just something to consider. The other thing to consider, and we'll talk about this over time, is net zero frameworks. Now, you're not doing this on your own. It can seem like that sometimes, but you're far from doing it on your own. There are net zero frameworks that have been set up, which are very practical, which look at how do you think about allocations? How do you think about doing this in the private markets? How do you think about doing this in sovereign debt and other securitized products, etc.? Basically, tricky questions. IIGCC, which is the Institutional Investors Group on Climate Change, which is essentially the European climate change body, is very popular because it has an interesting, useful framework, and over time it's something that perhaps you can think of using yourselves, because it gives you that framework, but also you're not in it on your own. You're following a framework that's tested and used by schemes up and down this country and all over the world. And so in those frameworks, what did they think of as elements of a good net zero strategy? We discussed that we would talk about that. Let's go through that quickly. Governance and strategy, objectives and targets. Now, hopefully you notice a commonality there between TCFD framework and that one. So the top of this set of 5 framework components is essentially TCFD. So if you do that, you do this as well. And then you've got the strategic asset allocation. How would you think about these factors, which is the net zero, when you're doing it in association with traditional financial investment indicators, including required return, expected return, and risk, and value at risk? So strategic asset allocation, how does this feed into that? Asset class alignment. Which asset classes would you look at first? Where are the dirty asset classes? What can you do about them? And then, of course, advocacy and engagement, again, a topic we've discussed a few times today. And if you look at it in those 5 buckets, and you think back to the one page I said would be our goal to get you down to on all of this stuff, you see the framework that seems to be emerging, the kind of things and the kinds of decisions you'll have to make as we go along, with, of course, data and fiduciary considerations top of mind. Some of the approaches to achieving net zero, as you can see on page 15, are strategic changes, mandate changes, active engagement, and of course, passive reduction. And let's not knock passive reduction when you're sitting in a pooled account somewhere where you have little say. It might actually be the only thing that you can do and monitor. And what does this mean for real world decarbonization? You've got some portfolio level things you can do. So decarbonization of the investment portfolio and increasing investment in climate solutions are on the portfolio side of things. And again, just to give you a sense, at Reddington, when we think of climate solutions, the first thing we do is think about risk and return, and then we think about the impact it has. We worked with London Civ to put together their renewables vehicle, which I believe you're invested in. And the idea is very, very much that this needs to make sense in a portfolio from an expected returns perspective, but it also needs to do its heavy lifting from an impact perspective. And there's a hierarchy there, clearly. And then you start looking at engagement and stewardship and asset class alignment. I won't go into a lot of detail about going faster than 2050, but I will say this. As the questions from Jonathan, or the comments and statements from Jonathan were leading us in this direction, 1.5 degrees is getting increasingly difficult. It's still possible, but it requires a level of policy action that, again, given the conjoined crises of global inflation as well as the war in Europe, it's becoming a vanishing possibility that we will actually hit 1.5. Having said that, what that really means is that the 1.5 by 2050 target is an excruciatingly difficult target. You've set your target 10 years before that. So you have to make some pragmatic decisions about how much of this is going to be about real-world decarbonization and how much of this is going to be about portfolio decarbonization, which you've already been very successful at, which is what you've done so far, which has been portfolio decarbonization. And my aim is to always bring that to the fore, where we make the trade-off between one and the other, with the primary understanding that we need to keep our investable universe as large as possible. When Jonathan was talking about this, and Rachel and I were talking about this before, if you were to invest only in net zero aligned companies today, you'd be investing in about 4% of the global index, which means you would not be able to pay pensions. So it's just not a possibility. So it's just, again, keeping that context always in mind, being practical and pragmatic with fiduciary responsibilities top of mind. So that is what we wanted to talk about. The rest of it is the appendix. Please do feel free to read it if you want. But the key thing I wanted to say was there's global convergence happening on what the interim target should be. We can go back and spend the next few months. We've only just started working with you, but certainly, hopefully in March, Rachel, to come up with the detailed analysis of your portfolio and where the pollution is coming from, where the polluters lie, or where the high impact is from a carbon risk exposure perspective, and then come up with a target off the back of that. Or we can go with the norm target, which is 50% by 2030. But we make that decision, which is a decision hopefully in January, and then with the data in March. And I'll let Rachel talk a little bit about what the next steps will be.
Perfect. Thank you very much, Anastasia. That was, I think that was a really informative run through for people of some of the challenges around TCFD. So thank you very much for that. Just in terms of next steps, obviously we are looking to receive the first detailed analysis of our portfolio in December this year. We'll obviously then look to bring that back to the committee for further discussion in January. And happy to take any further questions.
Thank you. Any question? Yes, Councillor Troughton.
Thank you so much for that presentation. I mean, I can really appreciate how much thought and hard work, and this is really innovative work, and I can't tell you how much I, for one, appreciate it. I'm just curious about whether there's a couple of things, and I hope it's okay to ask these sorts of questions. But firstly, do you anticipate that the opportunities for net zero investment will increase? And do you think the opportunities for the, the growth, economic growth of those opportunities will equal those of, the more traditional industries that, we've been invested in the past? And secondly, in terms of your risk factors, what weight do you give to political factors? I mean, for instance, in this country at the moment, we have a government that is, let's say, I think lacking in ambition on achieving net zero. But do you factor in the how is that worked into your risk matrix? I suppose is what I'm saying.
Thank you. So on your first question of, do we see growth in this space? I'm probably biased, but the answer is absolutely. And let's just stop for a moment. Again, I keep talking about context because sometimes I think we get into the nitty-gritty and we forget to look up. We're talking about the biggest change in the way the world produces and consumes services and products since the Industrial Revolution. This is a bigger change than the internet. So is there going to be change, growth, winners and losers? Probably. Very likely. Is it easy to predict what that's going to look like? No. But what we can see is when we start to see our fund managers, because the good news is that this committee and all capital allocators don't need to make those decisions. All you need to do is make sure the people who you choose to make those decisions for you, or who you monitor, who make those decisions for you, think in the way that you feel is managing your objectives. So if you're talking to managers and they're not able to give you good answers about where future winners are going to be and future losers, and how they're managing and changing their investment portfolios on the back of that, then that's a question. If you're looking at people who don't view this as a risk when they're investing in assets that have serious physical risk in the private markets, or an upside for that matter, then that's a question. These are the levers you have. You don't make investment decisions. You make decisions of those who make your investments for you. So whilst these are important things for us to consider, what you're really looking at is the answers from your fund managers need to work for you. And so that's where the engagement piece becomes. Your engagement is not with their underlying companies, it's with them. On your second point of political risk, the scenario analysis, one of the key things that it does is when you look at the 1.5 degree, and there was a great question from you, Chair, which was when you're looking at that 2-degree scenario, we're looking at what does the world need to do from a political and policy perspective to get to those numbers. When you're looking at the business as usual scenario, which is the 3-degree scenario, which is where we are now as a global economy, you're then looking at what actions are not being taken. So the scenario analysis through those 2 scenarios that we'll go into a lot more detail about this and give you lots of training and explain, that is where you're starting to see the world as it could be and the world as it should be and the world as it is. I mean, those are the differences between the scenarios. And then you're stress testing in a shock fashion your portfolio as it is today with what it would look like if those ideas and activities, both from a inflation interest rate perspective, gilt discounting, etc., actually came to be. So what it would say is, if the tide went out and and a 3-degree scenario was happening today, where would your risks lie, and how much would you want to do something about your portfolio to keep those risks at bay? And as some of the questions have indicated, there is a trade-off. You don't want to do too much because you might lose money, but you want to do enough to at least know where the risks are, etc. But we'll go into this later next year when we're doing scenario analysis work, but it is taken into account.
Yes, Councillor Ozan.
Yeah, I'd like to ask a question about the net zero target. In the future, it might, if it's different in different markets, that net zero target in Europe, in America, in China, for example, 2060, they say, how is it going to affect our investment strategy? Thank you.
So it's a really good question. Again, very similar response to what I just gave about that's taken into account in the scenario analysis. But also, and again, we can go into a lot of depth about all of this, and it's very interesting. But from a sort of bigger risk perspective, that's taken into account when you start to think about the risks. What we forget sometimes is China is the world's largest investor in renewables when you consider the US, Europe, and Australia put together. It's more than all of those three regions of the world put together. So the size of the Chinese economy and its commitment to investing in the future of its country and being energy independent, it cannot be underestimated. Of course, it's got a lot of other sustainability risks attached to it, which means that it may or may not be attractive for fund managers, but this is a question to ask them.
Thank you. Any more questions? Jonathan? Yes, I was anticipating that.
Cam, thank you very much as chair. Thank you so much. Anastasia, China being energy independent, tell me when. You know, I mean, look at what they're doing, striking deals with West African oil producing countries and things like that. I just cannot believe that you're going to be realistic and say that 2060 is set in stone. I cannot believe it.
Jonathan, unfortunately, in this world, nothing is set in stone. We're trying to model risks and work backwards. And as I was saying earlier, frankly, it's not our problem as capital allocators whether China sticks to its word or not. We're not trying to predict the world. We're trying to manage our risks and make sure that we take advantage of opportunities. That's what we do with all our investments. We're just expanding our field of inquiry.
Thank you. Any other question? If not, Rachel, I've got a question. Are we going to be in a position to set our interim targets in January?
So we will be receiving the data in December. We will certainly bring the data for further discussion and analysis in January. And essentially, the committee can consider the data and consider the extent of the challenge. It may be that following that discussion, the committee may feel it appropriate to set targets in March, but we would regard this as very much a decision of the committee as to the appropriate point to look to move forward with a firm target.
Henry?
Yeah, thanks. I've been listening to that. That was really interesting. I guess I just had a couple of observations. Yes, I agree. We can't do a great deal on our own, but I do think we should we can agree some philosophies. One, from a pure investment approach, we really should be pushing fast to avoid the risk of stranded assets, which end up having zero value. So it seems to me that we need to be ahead of the game in terms of our interim target, 50%. If the rest of the world is going 50% by 2030, I think we should be going faster than that. That at least puts us in a slightly advantageous position, as I see it. That's being very simplistic. I think we must engage. I think exiting is not a good idea. And I think there may be opportunities, which you picked up on one of your slides, about negative emissions, because if somebody or some firms or some industry comes up with a commercial approach that includes negative emissions, they're going to make a fortune, and we should be looking out for that for fund managers or countries which really look like they might be making some progress there. And I suppose my last comment, slightly echoing Jonathan's points, I really do think I take your points about China, but it's still building coal-fired stations by the week or by the day, and the jurisdiction is quite hopeless and has no interest in the rest of the world as I see it. And I do think at some stage we might have to look at an exit from Chinese investments, because I just worry that without something like that, they're not going to get the message that the rest of the world is worried about what's going on there in terms of their sustainability approach. I'm ignoring everything else for the purpose of this conversation. And if they do get it wrong, then we end up with even more stranded assets. So I do slightly think that we should be looking at the possibility down the line of exiting China particularly. I mean, I know India is also sort of powering up coal-fired stations as well, but they're probably going to be more amenable to listening to what the rest of the world says, whereas China won't. That's just a sort of personal view, and I may be totally wrong on that. But I think investment, certainly, let's push really hard short term to reduce our risk of stranded assets, keep engaging, and then just be alert to industries or countries that are really making progress on negative emissions, and keep an eye on potentially exiting from jurisdictions which don't really seem to be interested. Thank you.
Thanks, Henry. So I won't go into China again. Certainly, those sorts of conversations are going to be live, given you're going to be looking at this and looking at the data from this every year. So this is a long-term commitment to looking at climate risk, and over time we'll probably find new answers and new problems to solve. On that question of you should be going faster than 50% by 2030. In no way do I want to supersede the outcome of the actual numbers that will come through from your providers in December, and then our analysis of the back of that and advice off the back of that. But just to give you some lived experience of this, is that I suspect, and I don't know, but I suspect you have a very clean fund, because you've spent a lot of time decarbonizing large parts of it, which means that your lift, if you were to do 50%, will get you into trade-off territory on your fiduciary duty and investment universe being curtailed. We've had a very similar case elsewhere, where they wanted to do more than 50% because it was expedient on all sorts of variables, including on stakeholder action, etc. And we convinced them to some extent not to, because they were such a clean fund that any further reduction was not going to come easily. So you have to look at the context. I mean, the global economy has a slightly easier task of it than you may. I don't have the data yet, but I suspect that might be the case for you. But I believe you had your hand up, so.
I was going to say that's a really good point, but if we're already in an advantageous position because we are relatively clean, my point really is we don't want to lose that advantage. So yes, we might have to go. It might not be the 50% from now by 2030, but we still want to make sure that we are ahead of the game by 2030 and not lose the advantage, which I think you're saying we've already got by being much cleaner than most. We need to keep that advantage, because it seems to me from an investment approach, we have got to be in the position where we have less risk of ending up with stranded assets than others, and that's being totally commercial. We've got to look at what our position compared to others or relatively others, and keep that so that by the time we get to 2030, we still know whatever our margin ahead is, we've got to keep that or try and hopefully have improved it. But I do get the point. But that's what I'm trying to say. We must keep the advantage that we might have built up already.
Thank you for that. Councillor Ayers, do you have any question? Otherwise, we're going to move on. Councillor Ayers, Councillor Adebayo. So no more questions. Thank you very much for that. So thank you very much for the presentation. Very useful, very good discussion. Thank you. So we now move on to agenda item 6, TCFD consultation draft response. So can I invite Rachel to introduce the report, please? Thank you.
Yes, absolutely. In the interests of time, I think I am minded to ask that the response be treated as read unless there are specific comments. One point that I did want to add is that I have had one piece of feedback since publication that actually, particularly in view of some of the discussions that we've had as part of the training session, I think would be a really helpful addition to the response. And that was a suggestion from Aon that it would be sensible to add to the response a request for any statutory guidance to include some advice around fiduciary duty and how funds ought to respond to some of these debates. So I think the suggestion to government to include that line in any statutory guidance, given what we've just discussed so extensively, is a really helpful one. So I would like to add that comment in if the committee are happy. Other than that, are there any other specific comments around the response?
Any question or comment from anybody? Jonathan, any comment? Henry, anybody? So do we agree with the draft response to go forward? Yes? All right, everybody said yes. So we agreed. Yes. Thank you very much, Rachel, for that. So we'll move on to agenda item 6. Pension Fund Annual Report and Accounts Supplementary 3. Can I invite Rachel to introduce it, please? Thank you.
Microphone not working. Yes, so this sets out the pension fund report and accounts for the year 2021-22. We have a statutory duty to produce this report and to publish it by the 1st of December every year. Briefly speaking, the report sets out a number of statutory review items around the fund's performance during the year. It sets out the fund's statement of accounts and then follows with the inclusion of a number of the fund's statutory policies. The only comment I have of note on the accounts is that as we covered in September, these are the draft accounts and remain unaudited. The audit is now in progress, and we are looking for a completion early in the new year. Until such a time as we receive an audit completion certificate, we're asking the committee to approve the report and accounts in draft so that we are able to meet the statutory deadline for publication. But we will clearly then recirculate once any updates are made following the audit. But I'm happy to take any specific questions if there are any.
Any question on that? Henry, Jonathan, Councillor Ayers, Lynn? No? John, any question? Everybody seems to be happy, so. The Pension Committee is recommended to know this version of the Pension Fund Annual Report and Accounts, to approve publication of the draft accounts and distribution to interested parties ahead of audit and receipt of an audit certificate. So do we note and approve it? Yes, John,
Approved.
Jonathan, yes,
Approved.
Jonathan, Henry, do you approve and noted? Yes, everybody's okay. Yes, everybody's happy, noted and approved. Thank you. Sorry, I'm just going. I just want to make sure everybody's on the same page. Now we move to agenda item 7, conflict of interest policy, page 15. Can I invite Rachel to introduce the report? This report introduced the fund's conflict of interest policy, which has been reviewed and updated and has had some recommended updates as set out in the cover report. So Rachel, please, thank you.
Thank you, Chair. As the Chair has mentioned, this is a report. Conflicts of interest policy is updated on a triennial basis. It's been brought back to the committee as part of its routine updates. Again, in the interest of time, I'm happy to take the report as read, unless there are any specific questions.
Yes.
Thanks are due to Catherine, not just me. But no, I think the examples do help to set out quite clearly when members ought to disclose an interest, and I think they're quite a helpful addition.
Henry, okay.
Yeah, no, sorry. I feel sorry for officers on this one. I have a slight bugbear about these conflicts of interest policies. There's nothing wrong with this one, but I really do think at some stage we might just try and be a bit brave. This one runs to almost 20 pages. My view on conflicts is pretty simple. You should disclose all your interests. You should act with integrity. You should be aware of gifts. And if you have an actual or potential conflict, you should walk out the room. And I don't think a conflicts policy needs to go more than that, because I think that covers everything. But I've just noticed in other areas as well, people get longer and longer and longer on these policies for conflicts of interest. And I really do urge us, perhaps in 3 years' time, to sort of look at this. What's going to really work? Because I've certainly seen in my business life and my other political life that the longer a policy you have, the less people read it because it gets too complicated. And I really think we should be looking at simplicity and clarity to make it quite clear to people how they should behave. And I think a conflicts policy along the 4 lines I've already said is and should be entirely sensible and acceptable. I suspect I'm going to get nowhere on this one, but I really do think that we should perhaps just reflect on that for 3 years' time and just think about what do we really need to say in a conflicts policy? Does it really have to go to 20 pages? Because personally, I don't think it does. And it's a classic case of the concept of less is more. Thank you.
No, thank you for your comments, Henry. Duly noted. We will certainly give it consideration. Trying to be a little bit briefer when we update in 3 years' time. Clearly, we do recognise that we have a large number of policies in place, and certainly with some of our other policies, the risk policy, for example, we have tried in recent years to make those a little bit more user friendly, and we are quite mindful that length is an issue. Particularly for some areas where we have to comply with quite extensive guidance. So no, we are mindful of it, and we'll keep it in mind for the next update.
Any more comments or questions? Right. So the committee is the pension committee is recommended to approve the updated conflict of interest policy. Can we approve it, please? Approved? Yes. Thank you. Approved. As the agenda item 8 has been moved to the private session of the meeting, as the report includes exempt information. So we are moving to agenda item 9, annual report of the pension committee. Can I invite Rachel to introduce the report, please? Thank you.
Sorry, apologies, Chair. I've actually gone to the wrong section of the agenda. So item 9 is the annual report of the Pensions Committee. This sets out the work and achievements of the committee. It sets out the work and achievements of the committee during 2021-22. And the report itself will be presented to full council at the meeting tomorrow. I'm happy to answer any questions if there are any further comments.
Any comment or questions? This is the report going to the full council tomorrow. So if you have any questions or comment, or Councillor Troughton? No. Councillor Ozan? No. Henry?
Yeah, no.
Zhang?
I just want to say, as given in mind our previous comments, I really do think that you, Chairman, and officers should be congratulated, and perhaps all of us, for getting to a funding level of 106%. It's a phenomenal achievement, and I think you should make sure that the council, whoever it is, sort of understands that point, because it is. We've just had a long debate and some arguing about fiduciary responsibilities. But the fact is, to get out 106% from where I believe this was before I got involved, I think is really impressive. So I think you need to take some credit for that, and it should be probably communicated in some shape or form to the pensioners, potential pensioners, and others, because I think it's really, really impressive. So we're going to have more challenges in future, as we just discussed, with sustainable stuff and green investment. But I think, to be in this position now is a really good achievement. So I hope you won't underplay what the Pensions Committee has achieved. Thank you.
I agree with that comment. That's a fair comment. Thank you very much for that. Any other comment or questions? Yeah, I agree. Yes, it's a very hard job, but well done to everybody that, to the officers, to their guidance and everything. So it's been very good. Any other comment? Nope. So the Pensions Committee is recommended to know the report. This is recommended to know the report. Yeah. The noted? Yes, agreed, everybody? Jan? Yes. Eric, Jonathan? Agreed, yes, thank you. So we'll move on now to exempt items. No, sorry, this one. All right, yes, I can see that one. So any other business before we move to before we exclude the public? Any other business? No? So we're going to move into this one. So we are now moving to the exempted items. So agenda item 11, exclusion of the press and the public. Agenda item 8 and 12. Item 11 allows the consideration of the exempt information, proposed resolution. Has the public has been excluded? Yes, everybody's excluded, yeah, okay.